Here we go. And I'm going to share my screen. And, and start my slideshow from the beginning. Alrighty. So get my mug out of the way. Actually, I should probably stop my video for a second. Alrighty, there we go. So this is a discussion. Hi, this is Steve Hodgson at Modern Asset Management. It's December 27th, 2019. Merry Christmas, Happy Hanukkah, Happy New Year, all. This is a discussion to talk about an offer that was brought to me, and it's frankly, if it turns into something, it's way larger than anything that I have the capacity to do. So this is about writing short-term seconds for home sellers. And there's a disclaimer here. This is not a solicitation. This is informational discussion to understand people's goals and needs. This presentation is theoretical and not advice of any kind. I'm specifically not going to name the company that came to me because it's something that's new. So here we go. So a franchisee for one of the major real estate brokerages came to me. I have an old friend who's one of their top agents for many, many years. And he said, if there's anybody that can help us, it's this guy. So let's make sure. So it's not Compass, it's not Berkshire Hathaway, it's one of the other top five. They run a number of different franchises, and they understand that the California market has changed back to a neutral market from the seller's market that it's been. I've experienced price reduction in the high end and the low end. While California is made up of many markets, they're seeing consistent longer days on market, seeing higher demand from borrowers, and they're seeing properties that used to sell just because it was a good address now requiring to actually not only be priced right, but also look good and not have any pending issues, and like a leaky roof or bad furnace, that kind of thing. Excuse me. They're in the sell it fast business, and so they know how to price things to market. And what they are finding is they're starting to come across homeowners that don't have the money to fix up the house and get it market ready. We've done a number of those loans in the last couple of years, primarily for people that were at the brink of foreclosure, and we would rescue them if they had an offer in hand. This is different. This is somebody who's coming to market in a retail environment, and they don't have the money to paint, stage, like I said, a new water heater, new roof, but we're looking only at quick, easy contractor repairs or handyman things, a coat of paint, change the carpets, that kind of stuff. I'm not interested in getting into long-term rehab projects. I'm not interested in funding flippers who are going to take a year. Excuse me. I'm looking to partner with an aggressive real estate agency that's looking to close transactions in 4 months. So because the broker is paid purely by commission, they're absolutely motivated to move things as quickly as possible. So I got thinking, what were the things that I would need? I think that, and we've discussed this, and we're going out in a test for this after the new year. I'm going to write a half a dozen of these loans in the Sonoma and San Jose areas to test the market and see what the agents think, because that's who I think my market really is. It's the agents. What if I paid the contractors direct, so there was no chance that the homeowner would mess up and do something else with the money? What if I required that I always got a lien waiver before we started any work to make sure that there wasn't any chance of a mechanics lien getting ahead of my second? I also think that I have to make sure that the house is priced accurately to market, and that the combined loans are less than 85% of, of what the expected sale value is, so that I get, so there's enough room, they're not underwater when it comes time to pay all their closing costs and real estate fees and pay this loan back. We're going to keep the loan small. There's going to be a minimum rather, of $10,000, and I think we're going to be no more than $50,000 as we start. It will likely get bigger with bigger projects, but for right now, we're going to stay in this $25,000 is what my guess is we're going to be. The loans are going to be paid. You're going to have to open escrow at the time they take the loan. They're going to have a pre-authorized demand letter signed, sitting in escrow, and then it's figuring out what the other protections are. The recording of a second lien. The escrow company will give us a quick title report, and so our lien will be in second, possibly third position. So that's the product. It's lending to homeowners, owner occupied, which means I'm restricted on interest rate cap. My prior loans have all been to non-owner occupied, people vacating foreclosures. So I was able to charge hard money rates. So we took an example of a $25,000 loan for 1 year, would have a prepaid built-in interest of $2,342, and coming out of escrow would be $27,342, charging a 9% interest rate. So I'm trying to figure out how to structure these for investors, and frankly, my personal money that'll go through the company to fund these for the start and beyond. So I just grabbed, for example, what if the revenue share was 65-35? Those of you that know me for a while know that I have long disparaged the 50-50 equity split that you see in notes and second and foreclosure auctions and that kind of stuff. I think the person who puts up the money should get the most back. So I grabbed 65% out of the air. So then I ran out what that would be if 65% of the interest collected, and if the loan ran the full term of 12 months, that'd be just shy of 6, depending on the day of the week it's paid. So call that 6. If the house gets sold in 6 months, then it's going to pay an annualized return of 12. And if it is priced right and sells quickly, the investor would get a return of almost 18%. Those seem like magical numbers. So when I put this sheet up, I'm like, are these real? So I went and double check them again. I'm wondering if it's worth us doing the work for, in this case, $700. We'll have to play with this some more. We're going to add a 5% default interest charge. So the loan is 8.99 for a year, or when the house sells, or if the listing is canceled, or if it's just taken off the market. So if it's a 6-month listing and it runs out, then the interest rate jumps to, in this case, would jump to 14%. And that, I think, is my idea of protection. It puts me in the interest rates that I'm used to charging, and it gives me some room to work with the homeowner who something went wrong, to make sure that we're still have some margin to be able to treat people fairly. At a 14% interest rate, I'm perfectly willing to sit on that note for a while and let the house sell at a later date. So that's the deal structure. It's really simple: $25,000 out and a yield of $1,500 on that. So now this is the Q&A part. How does this stack up against other short-term things people are doing? I if there's something better with this kind of low risk level, tell me and I'll go do that and tell these guys thanks, but I can't help them. But it almost is, gosh, it's so vanilla, right? It's just so easy. Is the risk reward in line? Is a minimum yield of 6% a good place to park money short term? I think compared to people that are keeping capital dry on the sidelines, waiting for something big to happen, knowing that you're in and out. This is a place that we're going to be. Big question is, do you believe in California real estate? Are we past the peak? That's I think that depends on neighborhood to neighborhood. I'm in Marin right now, and things are still clipping along like there's nothing wrong outside of our borders. But I spend a lot of time in Orange County, and I'm seeing nice homes, seeing price reductions, seeing 10% off happening right now. What happens if we have another 2007, 8, 9? Marin went down 20%, maybe. Other neighborhoods went down by half or more. And I think you just decide what place you want to play. And if I take partners for these loans, I think you can stay as local as, I don't know, San Francisco, or as local as, in my case, I'd be picking up stuff in South Orange County to keep, because I know that market really well. But again, the rules to the borrower homeowner is, if the listing is canceled, then it's in default. If the house is pulled from the market, it's in default. If a year expires, the balloon is due and the note goes into default. So that is the show. Folks can text or unmute your microphone and jump in. Oh, it's just two of us. Do you have an opinion, Bettina?
Yeah. Can you hear me okay?
Yeah, go ahead.
Those that approached you with this idea, obviously they were confident that they have enough homeowners that would go for this kind of structure, or have you revealed the details yet? Or
so let me tell you what I know about that. I know that we have had the conversation, including maybe the broker and agent pay the interest out of their commission.
Oh, wow. Okay.
Right? Compass and Berkshire Hathaway have programs like this at zero interest.
Mm-hmm.
I have a friend in Orange County that has a listing with Compass, and they gave him $150,000 on a flip. And he's not going to be done inside the year.
Right.
And he gets it then converts to a high interest second, or a high interest note.
But within the first year, it's 0%?
Yeah.
Oh,
because it's who they are. Berkshire is Buffett.
Right.
And Compass has a full suite of other services that they do. They've got contractors. They keep it all in house. Now,
right.
the value to the agent paying it is the speed of the house selling,
right.
but also selling at a higher price.
Right.
So if the house sells for $50,000 more, their 5% of that is $2,500, and that matches up with what the interest is.
Right, especially if a small-time rehab could make a significant difference in the selling price.
Mm-hmm.
It makes, it makes certainly a lot of sense. I mean, if and so that the agents would be interested in this kind of an arrangement. In other words, you've gotten confirmation from the most, how shall I say, the top producing.
I got confirmation from the broker who used to be my tenant, and I've known for 20 years. He's sold my last two houses, bought and sold my last two houses. I've gotten confirmation from the head of his company, who owns 6 of these franchises in Northern California, from Sacramento to San Jose.
Mm-hmm.
And he's handpicking a few of his agents in Sonoma and San Jose, so that we have people that we know what they're doing.
Mm-hmm.
As we work out process, we want to make sure that we're not getting a new agent who is pricing a house way beyond what its value really is.
Right.
There'll be a CMA for each of these.
Okay.
And I'm not going to go with an appraisal, because that often is just problematic. But I'll get a competitive market analysis. I'll know the price per square foot. The ones here, I'll go drive, or have my partner drive, or somebody go take a look at. They want to make this work. They've got 1,600 agents.
Right.
And so if 1% of those needed something, right?
Right.
That's 160 loans, 160 of these a month.
Well, what happens if the listing is canceled or in default, or that, I'm just playing devil's advocate here, and the homeowner gives grief beyond compare to the broker or the agent? I mean, who then is responsible?
Well, the homeowner is responsible because they signed all the documents. They've
Correct.
agreed to a second from the beginning.
All right.
I think that if something goes horribly wrong, if something's terrible, and it's something, there's some malfeasance on the agent's part, that I would expect the broker to be backpedaling out of that and likely just pay the fee.
I see. Okay.
They thought that a fairly high percentage of their performers, of their big brokers,
Mm-hmm.
would just absorb the loan amount, or split it with the homeowner.
I understand. Okay. So as an incentive also for the homeowners to cooperate and not create obstacles and stay on track, just like you would expect a contractor would.
Right. Okay. And we're going to be selective with the contractors. What Compass is doing, because I know folks there, what Compass is doing is they put it into their team, and it's not the same general contractor. It's not the same contractor on the ground every time,
Mm-hmm.
but it's the same GC managing his subs.
I got it. Okay.
So all those two, that's where all of my deals that have taken forever are because the GC got distracted doing something else.
Right. Okay.
So if I've got 50 deals going through one general contractor,
Mm-hmm.
I'm important to him.
Right. Yeah. And are there any, I don't want to use the word penalty, but consequences if contractors run over budget, over time? I mean, what's holding their feet to the fire so that they do their share?
And that's really going to fall to the local agent and homeowner.
Mm-hmm.
I'm doing fund control, so I'm not releasing money up front.
Okay.
So likely it'll be a third. Say it's a $24,000 job.
Mm-hmm.
Here's $8,000 advance on materials.
Mm-hmm.
You get the $16,000 at the completion of the work.
And after the inspection, correct?
Yes.
Uh-huh.
Yes.
Right.
After, and particularly if there's something that requires city inspection, and that's just becomes so much more common now. I hadn't done a California property in a long time, and I did one last year, and we put in a water heater, replaced in kind, and we had to have the city come out.
Right. Okay. And so
10 years ago, you didn't need to do that.
Right. So you would get a scope of work, including all the permit fees,
Mm-hmm.
and then match up whoever comes in as an investor with the amount of money necessary in order to do that project within a specific period of time.
Right.
Okay.
And so I think I build kind of a little trade desk,
Mm-hmm.
where I'll email out. I have hypothetically, I'll email out, I've got these 2 offers this week, first come, first served.
Mm-hmm.
So, And and if you had somebody, if I had like I said, it's South Orange County, I'd probably I'd probably buy those until I ran out of money.
Mm-hmm.
But then you can say, do I want to buy condos? Do I want to buy so it's you get to, I think you get to have a little bit of control that way.
Right.
I think this is pretty much just how it starts. It feels like it should be a fund at some point, but again, those of you who've heard me before, I don't want to do fund administration.
Right.
I'd rather say, here's the note, you own the note.
Okay. I'm sure I'll have other questions. I'm just thinking if
I love when you think of it, because all kinds of good stuff gets uncovered.
it just needs to percolate through me, and then it just kind of comes to the surface as it does.
Yeah, and I said I'm going to do half a dozen and do half a dozen in January, and so I'll have some specs on what they really are to share.
So this is really not dependent upon the credit of the homeowner. This is really an equity.
Absolutely. It's entirely an asset loan. I won't run a credit report. They'll give me permission in the loan contract to do all the things that I do. But it's entirely based on time on market. So if you've got, that's what's going to make it tick. So I'm looking to turn money twice. I think that's a good plan for us. I think if we're in and out twice a year, that limits risk. It's adds some stability to our balance sheet. That there's some equity protection. Scott, you don't know, I've got a portfolio now of 1,400 unsecured loans, which we've built up in the last couple of years, and I said if I mixed in some performing second mortgages in there, that would just be prudent. But I like the company who came to me. It's a company I've known for a long time. We all see their commercials. The people that run this organization out of Sacramento are old school, been in the trenches a long time. The local franchise here in Marin County, like I said, is somebody that I've worked with for years. We did some staging finance loans a few years ago, and those were small little, like $4,000 in and out. I've done some big, again, these saving people from foreclosure, $30,000, $40,000. That included some home renovation and move out money and paying Bank of America on a monthly basis, all kinds of stuff like that. And that was just an awful lot of work.
You can assume, was that in California?
Yeah.
You can assume a loan in California? I was told you can't assume a loan in California. Is that?
No, I wasn't well, yes, you can.
Okay.
On a practical level, I don't know if there's a statute. Again, I'm not a lawyer.
I see.
I've paid first liens.
Okay.
Yeah. And we just, the debtor just created the online account and we funded the monthly payment.
Okay.
Yeah. But that was an instance. The one we did that was an instance where an LA landlord had squatters, and it took months to get those people out. Yeah. So it cost $3,000 a person to get them to move.
Oh my goodness.
Yeah. So not only do you not pay rent, you get $3,000 to leave.
Oh God.
So why am I moving to Utah? That was my mood today. Today I'm moving to Utah.
Yeah. So the sweet spot is going to be about a $500,000 price point on these homes?
Yeah, they're standard houses.
Okay.
Standard houses. So it'll be a $700,000-$800,000 house in Marin. It'll be $1 million house in San Francisco. It'll be a $500,000 house out in Fairfield. And again, it's a small loans and all on properties that if everything went completely to heck, that I've got the capacity to step in and create a rental. But that's not what I'm after here.
Right.
I'm not after that at all.
Right.
So what I think we do is we do plain vanilla, helping people that are just need 20 grand to get their house sold.
Right.
And take a reasonable return. So that's that. All right. So I'll send this out to folks that signed in but didn't join in, and hopefully I get some good feedback like you've given me. And we're coming out to a test in 15th of January. We're supposed to decide who the agents are supposed to be and hammer out the last of the details.
Mm-hmm. Mm-hmm. Yeah. Okay.
My attorney's given me lots of homework to do.
Oh, I'm sure. So, and so the opportunity will be relatively soon, you would think, in terms of.
Yeah, I think I think we're looking for end of January and February that I'm going to run out of my own money. If they bring me 10, I don't have capacity to do that. Mm-hmm. And keep up with our other stuff. Mm-hmm. I sold 3 of my long-term notes to have a little more cash to do this. Mm-hmm. So I'm confident that it's happening if I'm selling other lower performing assets.
Right. I like the idea right now, and this is in line with my strategy for the new year. Just short term, in and out, just having the liquidity and not tying funds up for a long period of time.
And then find things that are less work that have better return, and so just work on do what we've been trying to do. So
right. Okay.
I've got some 15-year notes, so why not some 6-month notes?
For sure. Yeah. So that's great. Thank you very much for detailing this out. I look forward to learning more and participating.
Right.
So how should I say? See you in the roaring 20s.
Absolutely. Okay. Well, thanks, guys.
Very good. Have a great weekend.
Okay.